Welcome to This Explainer. Today, we are putting a really fascinating company through the ultimate financial gauntlet. We're asking a big question. Can an old-school oilfield stock successfully pivot to powering AI data centers? To find out, we're going to stress test ProPetro Holding Corp, ticker symbol PUMP, against the legendary investment frameworks of three absolute titans: Warren Buffett, Peter Lynch, and Benjamin Graham. We're taking all the raw data, from the recent earnings reports to their shifting balance sheets, and running it right through the strict filters of these master investors.
So, here's the game plan for today. We'll kick things off with a quick snapshot of where the company is right now, then we'll apply the qualitative philosophies of Buffett, Lynch, and Graham. After that, we'll dive into the spreadsheets for some discounted cash flow modeling, and finally, bring it all together for a final recommendation.
All right, let's jump right into Section 1, getting a snapshot of this business in transition.
Just to ground us in the present reality, the stock is currently trading right around $15.51 a share. At this price point, ProPetro is carrying a market cap of roughly $1.8 billion, which places them squarely in that volatile mid-cap space. Now, they do generate over $1 billion in revenue, but as we're about to see, top-line revenue doesn't always equal bottom-line profit.
The absolute most crucial thing to understand here is that this is a business undergoing a massive transformation. Historically, they've been a regional service provider doing traditional hydraulic fracturing. Their core DNA is incredibly focused. Literally 100% of their completions revenue comes from the Permian Basin. But since 2022, they've aggressively invested over $1 billion to refresh their assets. And here's the twist you probably wouldn't expect from a traditional fracking company: they're targeting data centers. They've got this new ProPWR business line, which includes a massive strategic agreement with Caterpillar to acquire up to 2.1 gigawatts of power generation capacity. They are directly targeting off-grid microgrids and AI data centers. It's a huge pivot.
And this really gives you a sense of what we mean when we talk about their operations. This industry is ridiculously capital-intensive. You're looking at massive fleets of physical machinery out there in the Permian. Maintaining, upgrading, and converting all this heavy iron from traditional diesel to electric and dual fuel, that requires constant, heavy capital expenditure. And honestly, that reality is going to be central to how our gurus view this stock.
Okay, moving to Section 2. Let's bring in our first heavyweight, Warren Buffett. We're looking for that economic moat.
So Buffett demands a few key things, right? An economic moat, honest management, manageable debt, consistent earnings, and a high return on equity. Looking at our Buffett scorecard for ProPetro, it's definitely a mixed bag. Do they have a moat? Well, you could argue yes. Their 100% Permian focus and that early pivot into electric solutions give them a real edge over legacy diesel fleets. Their debt level? That's an easy pass. With a debt-to-equity ratio of just 0.24, they are definitely not over-leveraged. But here is where Buffett would hit the brakes hard: earnings consistency and return on equity. They recently posted a net loss in Q1 with an earnings per share of -3 cents. Even worse, their return on equity sits at a highly negative 32.75%. Buffett loves a compounding machine, but you can't compound negative earnings. Right now, they're burning equity, not compounding it.
Another thing Buffett relies heavily on is owner earnings. We can get a proxy for that here by looking at the free cash flow for their completions business. And wow, this metric shows some severe volatility. In the fourth quarter of 2025, they generated a very healthy $98 million in completions free cash flow. But literally 1 quarter later, that swung to a -$3 million, mostly due to working capital headwinds and some weather disruptions. For a guy like Buffett, who absolutely demands predictability and a clear margin of safety, this erratic cash generation plus that negative ROE means he'd almost certainly pass on the stock at current prices until those margins actually stabilize.
All right, let's shift gears to Section 3 and look through the Peter Lynch lens, focusing on story and growth.
If you know Peter Lynch, you know he loves a compelling narrative. He famously categorizes companies into distinct buckets, things like slow growers, stalwarts, cyclicals, or turnarounds. So the central debate for a Lynch investor right now is figuring out how to categorize ProPetro. Are they just a cyclical stock that's currently a victim of declining rig counts and the whims of crude oil prices? Or are they a classic turnaround play, a company leveraging legacy cash flows to fund this brilliant transition into off-grid data center power? The story itself is highly compelling, which Lynch would absolutely love.
But when Lynch checks his specific indicators, the plot thickens. ProPetro has a fantastic balance sheet with $289 million in total liquidity, and again, that low 0.24 debt-to-equity ratio really protects them on the downside. However, Lynch relies a lot on the PEG ratio, price to earnings relative to growth.
Because ProPetro's current PE is negative, dividing it by any growth rate mathematically breaks the PEG ratio entirely. On top of that, Lynch views insider buying as a massive positive signal. But recently, insiders actually sold a net of roughly 70,000 shares. Because of those negative earnings and that insider selling, Lynch would probably categorize this as a really interesting turnaround to keep on a watch list, but definitely not an immediate buy.
Moving on to Section 4. Enter Benjamin Graham and the strict hunt for a margin of safety.
Benjamin Graham does not care about your cool data center story. He cares about cold, hard numbers and an absolute, unforgiving margin of safety. We start with his defensive investor checklist. Adequate size? Yep, at $1.8 billion, they pass. Strong financial condition? Yes, their liquidity is solid. But then we hit a brick wall. Earning stability? Fail. They're currently posting net losses. Dividend record? Fail again. There's no continuous dividend history here at all. Graham's checklist is notoriously strict, and ProPetro gets knocked out pretty much immediately.
So that begs the question, how does Graham actually value a company that's losing money? The short answer is, he struggles to. Graham's intrinsic value formula is the square root of 22.5 multiplied by EPS and book value. Because you literally cannot find the square root of a negative number created by that negative 3-cent EPS, the formula just mathematically self-destructs. A strict Graham disciple wouldn't even touch this stock without 10 years of stable, positive earnings and a deep discount to tangible book value.
Okay, Section 5. Let's step away from the investment philosophies for a second and just crunch the raw numbers with some valuation models. Since the qualitative gurus are hesitant, let's see what a pure quantitative model thinks by building a base case discounted cash flow, or DCF, valuation. To build this, we have to forecast future free cash flows. Now, we know management's target revenue for the year is between $1.65 billion and $1.8 billion, with targeted EBITDA margins of 20 to 22%. Since our source materials don't give us specific discount figures, we're going to apply an industry-standard 10% weighted average cost of capital, which makes sense for cyclical energy, and a conservative 2% terminal growth rate just to match long-term inflation. But here's the thing about DCF models, they are highly sensitive. We ran a sensitivity table varying that 10% WACC and 2% terminal growth, and the fair value fluctuates wildly. Why? Well, it all comes down to their massive $250 million to $300 million capital expenditure budget. The big takeaway here is that if they hit their 15% return targets on these new electric fleets and data center contracts, you win big, and the fair value easily pushes into the $20 range. But if oil prices crash and utilization drops, your fair value basically evaporates. And since PE ratios are completely useless when a company has negative net income, we have to bypass that by using an alternative metric, specifically enterprise value to EBITDA. When you compare ProPetro against major peers mentioned in our data, like SLB or Baker Hughes, ProPetro is actually trading at a relative discount. Remember, they still managed an adjusted EBITDA of $36 million in Q1 despite the net loss. If they can actually pull off their 12% projected EBITDA growth rate through 2027, their current valuation multiples look surprisingly cheap compared to the broader energy sector. All right, we've reached Section 6. Time for the synthesis and our final recommendation. The crucial takeaway here is that we are getting some seriously conflicting signals. The future potential of this pivot is massive, but current earnings are undeniably negative. Take a look at our master scorecard. Wall Street analysts are actually largely bullish. They have a median price target of $17, which is about a 9.6% upside from the current price. Our DCF models also suggest potential upside, but only if management executes perfectly on that massive capital expenditure. On the flip side, our legendary gurus, Buffett, Lynch, and Graham, are all essentially telling us to wait on the sidelines until the core business proves it can actually return to consistent profitability. So, blending all of these insights together, our final recommendation at the current price is a solid hold. This company is actively trying to bridge two very different worlds, managing the brutal pricing pressures of legacy hydraulic fracturing while chasing the incredible upside of data center and microgrid expansion. They definitely have the balance sheet to survive this transition, but the execution risk is just too high right now, making it a bit too speculative for strict value investors. The real trigger to buy here would be a clear return to positive net income and a stabilization of that wild free cash flow. I want to leave you with this thought from their CEO. To deliver the energy our modern society needs, we have to innovate and invest. Well, ProPetro has certainly invested, pouring over $1 billion into their future. The real question you have to answer as an investor is, will this massive, capital-heavy transformation power up the future of the company, or are they just going to end up running out of gas? Definitely keep a close eye on their next earnings report. Thanks for joining this explainer.